Markets applauding the deal between Greece and its creditors. Michael Ingram, markets commentator at BGC Partners, joins me. Michael, any surprises at all by the way the markets are responding as seeing a decent rally in stocks, although the euro not so strong?
Well, perhaps a little bit. I mean, until the last hour before the opening, futures were trading deeply into the red, and perhaps not surprisingly, because over the weekend it became quite clear that there wasn't even a common position among Europe's creditors. Having said that, I mean, there appears to have been effectively a last-minute capitulation among European creditors towards the German position, which is, of course, incredibly harsh austerity, and that has now been presented to the market as an agreement. On the face of it, yeah, that's great. We have an agreement where previously we had none. Now the massive question is any of this workable? We still don't know a lot of the big numbers, but we know the broad outline. The broad outline is a lot more debt being loaded onto the very narrow shoulders of the Greek economy. I think that whereas a short-term rally in risk assets, in periphery debt, in European equity is understandable, I'm not quite sure the market's thinking this fully through, and I'm fully of the opinion that we're going to be revisiting a Grexit scenario in 2016 once this program actually once again proves to be unworkable.
In fact, you don't think the deal solves anything. In the short term, we have this week a vote by the Greek parliament. Is there any chance that that fails? And what happens to the markets if that's the case?
Well, I think failure of a vote on Wednesday is a possibility. I don't think it's a likelihood. After all, the vote on Saturday morning passed by a very substantial margin. But I mean, the government is going to have to rely on opposition votes increasingly. It's very clear that many parts of the Syriza party are already extremely uncomfortable in what they're being asked to do. I think ultimately we will see a fragmentation of Syriza, and I strongly suspect that we will see another round of elections before the end of the year. And of course, many will say, well, that's what the Troika wanted all along. A lot of it was about regime change. And in fact, the next most likely outcome is for another New Democracy-led administration.
So if you think this deal really doesn't resolve the problem and a Grexit is back on the table for next year, what happens to the markets between now and then? Do the markets just eventually factor in that Greece is going to be a long-term problem, or are we seeing a potential for another steep sell-off in some other sort of asset?
Well, I think the market's attention span is almost like a goldfish at the moment, because we've seen a bailout in 2010, didn't work. 2012 didn't work. What are the odds that this bailout's going to work, given that the starting position of the Greek real economy is so much worse? I mean, you have clearly seen some element of contagion among risky assets. Everybody keeps telling me and everybody else just how small and insignificant the Greek economy is. I agree, but look at the price action, look at where periphery debt's gone, look at where European equity's gone. I think that the issue with Greece has always been beyond the scale of its economy. It's the sort of socio-political implications. So, for instance, I mean, all the policymakers involved in cobbling this deal together with Greece come out with very little credibility, least of all the IMF. I mean, it seems to me that they've performed a second U-turn within the space of 10 days. They quite happily sat down with the Greek government over the last 5 months to try and hammer out a program, turned around and said, well, actually, that doesn't get you to debt sustainability, and now seem to be happy to sign on to a program which presumably is going to be worse still. And it goes without saying that policymakers within the European Commission don't come out of this looking very, very well, and certainly a lack of cohesion evidence there. So I think it's very difficult to pin it down to a particular event. I think there's a feeling generally that there's a lot of bad policy making going on this side of the Atlantic, and you'd have to say on present form that isn't going to change, and that ultimately is going to be factored into risk premia across the board. And it's one of the reasons why I don't believe that the European equity market should be trading on par with the US, because I think it's fundamentally riskier.
Michael Ingram, BGC Partners, thanks very much. I'm Rhonda Schaffler for The Street.